Well, who do you guys think won this round?
Erie.
Think Erie did?
Erie or Baldwin?
Erie or Baldwin, one of the two. I'll tell you, and I'll leave you in suspense, but the score ended up being really, really close. So, but I will leave you in suspense on that, and we'll go take a look at how the round turned out. I can tell you this, the computer team did not come close to winning, so as I predicted. However, I will also note that the computer team made a lot of investments this round that weren't matched by the student team, so the future may be a little more uncertain in terms of their success or lack thereof. Sales, look at that. Pretty good. Team Erie, I wouldn't say dominated, but clearly had an advantage in sales, followed closely by the computer team and Baldwin. Some little bit of laggards with Ferris, Andrews, and Chester. You know, about half actually. You know, of the sales that Erie put out. So, in fact, Ferris a little less than half. So, profits. Though we did have a Baldwin, just half the teams had profits. Pretty good sized losses for Andrews, Chester, and Ferris. Cumulative, I don't get too concerned about. Look at the contribution margins. You know, we're the four teams here in the middle, well over 30%. Digby, the computer team, the least of those, but 37, 38, 39. So we're starting to see contribution margins. We're starting to see teams really pay attention to contribution margins and building those up big time. Andrews was just short of 30%. However, they had a huge SG&A. My guess is that's more a reflection on their low sales. They spent quite a bit probably, and this is a good, this is where I like to look at this up here and form some hypotheses and then kind of test those as I go down and take a look at it. But my guess is they probably spent a decent amount of money on SG&A, maybe similar to other teams, but maybe their buying criteria and stuff wasn't quite matched up. That's just a bit of a guess at this point in time. Maybe we'll see as we kind of go down. Every team's double digits in SG&A to sales. That's a little bit unusual from my experience, okay? A little bit unusual from my experience. Not that it's bad, and generally most teams are double digits, so when I say that's unusual, it's just unusual that there's not a team or two that's a little bit below double digits, because generally most teams are at least double digits in SG&A. But to have every team be double digits in SG&A, a little bit unusual. Our stocks, so, the first four teams here, Andrew, Baldwin, Chester, and Digby, all have still more shares outstanding than what they started with. Okay, I don't know if they've bought or sold any recently. Looks like Erie, in particular, continues to reduce the number of shares outstanding or continues to buy back shares outstanding, which should give them an advantage in what two ways?
And
ROE. Is that what you said? Okay, ROE, and especially in, yeah, exactly, right? It should give them a bit of an advantage in that, they've got, 600,000 fewer shares than the computer team, for example, roughly, okay, which is, what, about a third less, maybe, something like that? Not quite. Quarter less, 30%. We'll go with that. How about? So that's substantial. It means they could earn 30% less and still beat them in earnings per share and possibly ROE. The ROE is we got a little debt. We got some teams. Andrews not borrowing much, but every other team looks like using a little bit of long-term debt. I don't think we saw the emergency loan, so maybe that's why that we have in the past. So, glancing through it, depreciation, we're seeing some pretty big numbers for Digby and Erie and Baldwin. So, three teams that were profitable are, they've got depreciation, so they've invested some money, obviously, somewhere along the line, and that's creating a need for some depreciation. That doesn't mean small can't work as well. You can go small in this game and still be very successful. Here's the investment that I talked about. I glanced at that this morning and I said, wow. I mean, Andrews and Baldwin invested nothing this year in plant improvements unless it was a net zero. That would be a little bit unusual, but they may have, say, sold a bunch of capacity and maybe bought back some automation or something. So you could have a net zero there. That can happen. That'd be a bit unusual. But we see nets here. These are pretty big, 15, 22, 19. But then you see Team Digby, the computer team, investing $46 million. And you'd have to go back and see what they did last year or last round to compare it to this round. It's hard to glance at. It kind of looks to me like maybe it was some capacity and a little mixture of capacity and automation. It doesn't look like this year that they spent money on introducing a new product, which they have in the past, and that's, as you guys know, that's big dollars. But it doesn't look like it this round, so it looks like they invested in some other things. Purchase of common stock. So Andrews bought back a little bit of common stock, as did Erie. So Andrews did buy back some this round. Sale of common stock, only Team Digby, only the computer team. He hasn't been listening to me. The computer team hasn't. He never does. Debt, long-term debt issued, sure. Early retirement of long-term debt. So Andrew's paying off some debt. Interesting. Current debt. Lots of current debt that got retired, but we had a lot of emergency loans last round, so that'd probably be the current debt that got retired. And we see just a couple teams issued some current debt, emergency loans. I wanted to go up and look at inventory. Not huge numbers. I mean, it looks like they kind of offset. A couple teams reduced inventory, a couple teams increased or had an increase in inventory, but pretty equal. And yet there's a lot of inventory on hand again. Okay, I did a quick math, and I think I came up with 150 million, somewhere in that neighborhood, of inventory that's still on hand. It looks like it's pretty spread out. And when we get down to the production, we'll see that. But it looks pretty spread out, like it's not concentrated in any one segment or anything, and so it's kind of an interesting phenomenon. Any company's way bigger than others, total assets. You see these teams, Baldwin, Digby, Erie, remember they had the more depreciation, so it's not surprising that they have greater fixed assets, right? It's going to be those fixed assets that we're going to be appreciating. Total assets, Team Digby quite a bit bigger than some other teams, which is going to hurt them on ROE and perhaps on it's going to hurt them on ROA and perhaps on ROE, but that'll depend on what kind of debt they're holding too. So liabilities, yeah, they got a lot of debt too, and so their total equity, yeah, it's quite a bit bigger than other teams. Team Chester, little itty bitty team, right? 34 in terms of total equity, 34 million. Might give them an advantage going ahead if they can be profitable in terms of their ROE. Chester wasn't profitable this round, so they got a little work to do. Little investment here, it looks like. Other fees, write-offs, TQM, bonus. Baldwin, Chester, Erie, looks like they all invested pretty greatly in probably TQM. Digby to a lesser extent, Ferris almost none at all, and Andrews probably none at all. Interest, so we're seeing the use of some debt. Again, those middle teams there. I forget, what do we have? Just a couple teams with emergency loans? Two teams, Chester and Andrews. Starting to use a little capacity. Andrews really the only team with a bunch of capacity, a lot of excess capacity, I would say. These teams still all have plenty of capacity. I mean, there's still excess capacity out there, but it's starting to get used up a bit. So here's just glancing at it, I mean, you can see the inventory kind of looks like it's spread out. You can see that, most teams had, a decent amount of inventory. Erie had 3 where they sold out. That could be good or bad, right? They may have missed on some opportunity big time. Okay. But they're the only team that probably, that didn't have much inventory. The rest of the teams all had quite a bit of inventory still left over, including the. Never mind. Okay. And we were looking at Team Digby, the computer team, and kind of trying to figure out what they might have done with their investment. Again, I don't see a new product coming online, so it doesn't look like they invested money into that. It looks like some of these automations might have bumped up a little bit, and they probably did some investing in capacities, I'm guessing. And we could go back last round. It takes a little long to do that here, but you could go back to last round and see if that were the case. Ferris has got another product coming on. It's so interesting that they have another product coming on. What was one of the questions on your guys' assignment? It was, where is product cap going to come in? Did everybody get that right? That it was coming in as a traditional product? I would tell you that's a bit unusual for a new product. It's unusual to introduce a new product into the traditional segment. Most new products get introduced in one of the high-end segments. Okay, most, but this one was introduced into into that traditional segment. Ended up with still some inventory left over. Not very good contribution margin, and I don't know if that had anything to do with being introduced into that particular segment as opposed to another segment, but not a very good contribution margin. Pretty high labor costs. We're starting to see some teams work down the labor costs kind of big time. That's unusual. I didn't notice that. Looking at Chester, their labor cost for their traditional product was less than their labor cost for their low-end product. Oh, that's why. They have automation the same in both of them, and so normally your labor cost here would be a little bit higher, but they didn't have any overtime here. Okay, and so that's the reason why this labor cost a little bit higher than this one, because they didn't have any overtime. Okay. Traditional segment. Everybody's still competing pretty vigorously in the traditional segment. Although Erie, hard to say they dominated, but Erie had a strong position for sure in the traditional segment. And everybody's kind of gathered around there, so nobody's moving far from the ideal spot. Pricing looks to be, everybody's kind of ganged up there as well. Okay, spending over here. Yeah, you see, Erie and Andrews. Again, Andrews, and we talked about that up above. They had a lot of money spent on SG&A, but perhaps let's look at the other criteria. Age would have got them here, right? So we get back to that buying criteria, and here's a case where age probably got them. They got a product here that at the end of the year was 3 years old, and ideal age is the number one buying criteria here, and they want it to be right at 2 years old. Okay, so that means that it started the year it was over 2 years old, had to be, because by the end of the year it was over 3 years old. So it was always a little bit older than what the customers wanted.
That had to do a little bit with the inventory too.
Could be.
We had half our sales were in inventory.
Gotcha. Yep. And so that might be a case where spending a lot of money, even though it didn't look like it paid off. At least you kept that product relevant and out there, and you sold way more. If you hadn't spent the money, you might have really been hurting in that case. So, yeah. But age was certainly, it kind of confirms what I was saying up above. Just, I like to look at that, get a little hypothesis, see if that's correct when I get down there, and it looks like I was absolutely correct there. Erie and Ferris kind of dominating here in the low end. Erie selling, 3,800 or 3.8 million units, although they still had quite a bit left in inventory, so they obviously didn't sell as much as they did. Ferris really lowered their price. Okay, I'm almost surprised that they didn't sell out or sell more. They took the low price approach and sold a bunch, no doubt, but probably this is what kept them from selling a bunch more, right? I mean, look at and that could be an okay thing. right? Here's your comparison, right? Well, we lowered our price. We're $3 lower per unit than everybody else on 2.6 million units. So what's that? $7.5, $8 million, right? That they gave up on price, but they also spent $4.5 million less. Okay, so maybe a little trade-off there. I don't know if that's the magic. There's no magic number here, right? In terms of what you spend on marketing and in terms of what it produces and where it gets you and all those other things. No magic number there. So, although going into next year, their customer survey isn't too bad, but you see like Erie's team, customer awareness 94%, customer accessibility 90%. So that's going to get them a little bit of a head start going into next year. What was your guys'? What was Ferris's? What was your guys' contribution margin on feet? Just out of curiosity. At a $15 price.
It was only 6.
What?
6%.
Oh yeah, only 6%. So lowering the price or killed the. What do you guys have for automation in that one?
That one, not very much.
5.
Okay, yeah. So you haven't raised that up very much, and so those contributing factors kept that contribution margin pretty low. Gave them some market share, but a pretty low contribution margin. So. High-end Erie could have sold a lot more. Erie gave up a bunch there. Okay, looks like they could have sold 26% or so, and they only sold 17.5%, 18%. So, gave up 6 or 8%, probably closer to 8% there in terms of the high end. So, 324, 350,000 units maybe, somewhere in that neighborhood. So, pretty good chunk. And Baldwin and Digby were able to kind of take advantage of that to a lesser extent. Chester, okay. So that was kind of interesting that they ran out. Again, we said that up above, right? That they didn't have inventory at all in a couple of those segments, and we wondered if they might have hurt themselves a little bit by selling out. And the answer is yeah. They sold 860,000, but just that quick math, they could have sold another 350,000, so they could have sold roughly 50% more than they did sell. Somewhere's in that neighborhood, yeah, which would have been huge, right? And we had, what was the new one that you guys introduced? Was that Fade?
Yeah.
Okay. So it came in and sold reasonably well. But did that come in last year?
Yeah.
Started selling last year? Okay. Performance. Here's where the computer team did kind of kick it in the performance segment. Although Baldwin's not too far behind it, Erie's still pretty competitive. You guys pay attention to the growth for next year? What the predictions are? Okay. Yeah, here's, Andrews still spend a lot of money here, quite a bit of money, but again, age would have got them, right? Age would have been one factor at least that got them. Although ideal age isn't a huge thing on there. Their MTBF should be okay. Is it? Yeah, but their location then, the next factor is what would have got them here in the performance segment. Okay. So again, you got to, everything's got to fit together, right? Spending money on marketing is wonderful, and it's going to help. There's no question, regardless of where you're at. But if you're not matching up with the buying criteria all that well, it can get pretty expensive too. Size, Team Baldwin followed by Team Erie. Remember in the practice rounds, Digby dominated big time in the all the performance size and high, and not so much this particular round, or this particular game. Actual potential. There's your map. So again, you can kind of tell. Looks to me like Ferris has probably given up on performance and size, and that's fine. That's a normal strategy, right? Introducing some new products. They got another new one, Fizz. Looks like coming online here, or did that come online this round? Comes online next round. Yep. Yep. So Fizz is coming in line. Going to be ready next round. It's positioned pretty well, looks like. Chester's position, look at that. They got out in front a little bit. That's kind of interesting. That actually may be a little. They're outside of that line. They may have gotten a little too far ahead. Okay, that's possible. That can happen a little bit. Bumping up against that line isn't too bad of a spot to be, but when you get out ahead of the line, it's possible that could hurt you a little bit. Okay, yeah, being dead on the line on these high-end categories isn't too bad. Now, that said, obviously those are going to get enveloped pretty quickly by the line next round, so they'll be in a pretty good position going into next round without any question. So, HR, we're seeing lots of good. Everybody's kicking butt on the computer team there because we're seeing 8, 9, 10% in terms of productivity. So again, that's why we're seeing the contribution margins. Okay, you kind of look at that and you go, man, how's that happening? But we're seeing some automation. Okay, we're seeing some investing in HR here, which is having an effect on labor costs. And as we'll see below, we're seeing some investment now in TQM, which is going to have a huge effect on labor costs and material costs and cycle time, which is especially important for those teams competing in the high ends, right? Getting that cycle time reduced so that you can keep your product more up to date, okay, is just huge. Okay. Admin costs, we're seeing some huge savings here. Again, your admin costs they're not a huge cost, a few $1 million, but still you save 50% on that. It's not, it's not chicken feed by any means. And increasing your demand a little bit. We see a couple teams, Ferris and Andrews spent nothing. Digby, the computer team, while they invested a ton in plant improvements, they didn't invest that much here in TQM. So we'll see how that plays out over time. So, okay, you want to see who won? Maybe.
I want to know how CAP is in the traditional when they're 5 and 15. Do that.
How is CAP in the traditional when we look at their coordinates? 5 and 15. Let's go to the big one then. It's usually the easier place to tell. So you're 5 on performance, right?
Yeah.
Which should be right there. And 15. So they're in the low end now, according to this.
Well, that's
And yet they show up as the traditional end up above, don't they?
So how are we supposed to tell if it was in the traditional?
Yeah, that's interesting.
because to me it looks like they're
Yeah, that was one of our questions too, and,
looks low in to me.
that's what we thought too.
Well, and where did it sell here? It sold in the traditional segment. It sold 235 units, and in the low end segment, it sold only 110 units. So that's why it got classified that way. But that's weird. Yeah, no, you guys are right. I mean, it ended up coming in as a low end product when you look at the perceptual map. But it got classified that way just because it sold more for whatever reason. Maybe the competition was too fierce in the low end, and it ended up selling. It didn't sell a whole bunch as it was anyhow, right? Okay, I mean, it only sold a couple 100,000 units, a few 100,000 units, and it just happened to sell more in the traditional segment. The competition may have been a little less there, and so it picked some of those up. That's interesting. Good catch. Yeah, good catch. And I don't know what Tony, if he was here, we could ask him, but I don't know what his intent was for that product. If it was to enter, then maybe right towards the top of the low end, which is where it entered. I don't know. So it's interesting. That, by the way, I think your guide even kind of tells you, introducing products in the low and traditional segments isn't probably that good of an investment. You'd be better off letting other products slide back into those areas if you want extra products in those other areas. So, okay, other questions? Let's take a look, see who won. There was, by the way, for sure, I think every team except Andrews, and Andrews was bumping right up against it, but every team got a discount for leverage. So we saw quite a bit of debt and quite a bit of leverage being used, which I don't think that's a bad thing. Okay. Again, the reason you get a discount for it, while I continue to say it's not a bad thing, including the computer team, by the way, but is simply that leverage means you're taking on a little more risk. Okay. And so you're getting penalized for taking on a little bit of risk, even though in this game, taking on a little bit of risk is not necessarily a bad thing, right? In real life, taking on a little risk is not necessarily a bad thing, but it's called risk for a reason, right? So, okay, so for earnings per share, Team Erie, followed by Team Baldwin, and then Team Digby, and Team Andrews, Chester Ferris. ROE, still Team Erie, followed by Baldwin and Digby. So we're thumping on the computer team, but then got turned around in contribution margin. Baldwin made a stand there and got the highest points there, followed by the Chester, and then Erie. Stock price, Erie had the best move in stock price, followed by Baldwin. Reasserted themselves in profit as well. Cash flow there too. So coming in before we start deducting any points, we got 98 to 92 Erie over Baldwin. We know each team got a discount for leverage. Emergency loan, neither team had that. But Team Erie also had a discount for working capital. So their working capital was a little low, but nevertheless, they held on to win by 1 point, 88 to 87. So kind of a congrats, but that's a close round. So Team Baldwin came really, really close in that round. And you can see they thumped on the computer team pretty well. But again, I'm not going to give up on the computer team because they invested a lot of money into plant improvements, and we'll see if those investments tend to pay off over time. Generally they do. Generally those investments will pay off. So congrats to Team Erie. Hiram's not here though, so he'll have to do the assignment anyways. You guys might want to let him know, since he didn't show up to get his crown or whatever, or his medal. He'll have to do the assignment. I'll let him know that. It's almost April Fool's, isn't it? What is today? Yeah, a couple days for April Fool's. Oh, the 1st. Yeah, that's spring fling. Yeah, it'll be April Fool's. So, yeah.
Psych, there's no spring fling.
Any other questions?
I have a question.
Okay.
I bought a lot of bonds back.
Mm-hmm.
Do you think that was a wise move or not?
Is it a wise move to buy back bonds? Here's what I say with this game. Okay, in this game you've got a rapidly growing industry. It's a very rapidly growing industry, except for next round. Next round we know it's going to take a thumping, right? Because it's telling us that. In real life, if I were in a rapidly growing industry, I would tend to want to invest as much as I could into things that would continue to improve my productivity, improve my ability to make more items, improve all those things, okay? And so that would always be, in a fast-growing industry like this, that would always be my first priority, okay? Paying down debt would be somewhere towards the bottom of my priority list, okay? I'd be doing mostly the opposite. I'd be looking at ways I could borrow. Borrowing money, keep in mind, when you borrow money, it's not compounded, but the growth rates are compounded, okay? So borrowing money is a real linear thing. You pay it down maybe you don't, you pay the interest on it, whichever way, but it doesn't compound as long as you pay the interest every year, which you're required to do, which you get a tax deduction for, remember, okay? Whereas our growth is compounded, meaning that if I borrowed money at 10% and our growth was at 10%, over time that growth is going to far exceed what my borrowing costs are. So that's a really long explanation for the use of debt and the use of leverage, which of course brings on risk. Okay, and so there's always risk. Next year, you know, the market's not looking so good. You know, there's going to be some risk having a lot of debt maybe next year, but we'll see. But over time, this industry is supposed to continue to grow pretty rapidly. So, does that answer your question? Okay.